Yesterday, gold was rising. Today, it suddenly falls. Silver jumps 5% and then drops in a few hours. But here is the real question most people never ask. Who decides these prices? And how can millions of people trade gold and silver without even seeing the metal? Today, we will uncover how people actually trade gold and silver today, which form is better, what truly moves their prices, and why the market right now feels so wild and unpredictable. Welcome to the Wealth Story. Let's start with something important. Across the world, most gold and silver trading today does not happen in jewelry shops. It happens inside the financial system. One gold ETFs and silver ETFs, the most common way globally. A gold ETF or silver ETF is a financial product that tracks the price of real gold or silver. You simply buy it from your local stock exchange, just like buying a normal share. For example, in India, through the National Stock Exchange of India. In the United States, through the New York Stock Exchange. In the United Kingdom, through the London Stock Exchange. And in Japan, through the Tokyo Stock Exchange. So the rule is very simple. You don't buy gold ETFs from one global exchange. You buy them from your country's stock exchange. For you as an investor, no storage problem, no purity worry, no making charges, and very easy buying and selling. This is why globally, ETFs are the most popular non-physical way to invest in gold and silver. 2. Digital gold platforms. Digital gold lets you buy very small quantities of gold online. The platform stores the metal for you. It feels extremely simple and convenient. But remember one thing. Here, you are trusting the platform for storage, delivery, and future liquidity. So it works well for small and casual buying, but not ideal for serious long-term investors. 3. Sovereign gold bonds, only for India viewers. If you are watching from India, there is one more option. Sovereign gold bonds are issued by the government of India through the Reserve Bank of India. You don't get physical gold. You get a bond linked to gold prices, and you also earn interest. So if you are watching this video from anywhere in the world, for flexibility and easy buying and selling, gold ETFs and silver ETFs are usually the best starting point. Digital gold is convenience-based, and country-specific bonds like SGBs depend on your local government. Let's compare the main options: ETFs and digital gold. ETFs are easy to buy if you already have a brokerage account. Fees are low and transparent. You can buy or sell instantly, and everything's regulated. Digital gold is great for small investors. Buy a few dollars worth at a time, sometimes with the option for physical delivery. But fees can be less clear, and you need to read the fine print. For most people in the US or Europe, ETFs are the simplest, cheapest choice. Digital gold is best if you want to start small or live in a market where it's popular. For most, ETFs win on cost and convenience. So, what really makes gold and silver prices jump up and down so dramatically? If you've ever watched the price charts, you know they can move in ways that seem unpredictable. But there are actually some powerful forces at work behind the scenes, shaping every spike and dip. First, interest rates. When interest rates are high, investors often prefer to put their money into bonds and savings accounts, which offer better returns. That means less demand for gold, so gold prices tend to drop. Higher rates make it more expensive to hold gold, which doesn't pay any interest or dividends. But when rates are low, gold suddenly looks much more attractive. Investors start to see gold as a safer place to park their money, especially when other investments aren't offering much growth. This can send gold prices climbing. Second, the US dollar. Gold is priced in dollars all over the world, so the strength or weakness of the dollar has a direct impact on gold's value. If the dollar gets stronger, it takes fewer dollars to buy the same amount of gold, making gold cheaper for people using other currencies. But if the dollar weakens, gold becomes more expensive, and its price usually rises. Third, fear. In times of crisis, whether it's a stock market crash, a global pandemic, or political turmoil, investors often rush to gold for safety. This flight to safety can drive prices up quickly as everyone scrambles to protect their wealth. Fourth, industrial demand. This is especially important for silver, which isn't just a precious metal but also a key ingredient in technology and green energy. Silver is used in everything from solar panels to electric vehicles and electronics, so when these industries boom, so does demand for silver. Central banks, especially the U.S. Federal Reserve, play a huge role by setting interest rates and influencing the value of the dollar. Their decisions ripple through global markets, affecting gold and silver prices everywhere. When the world gets nervous about war, recession, inflation, or even unexpected events, gold and silver become the go-to safe havens. Investors move their money into these metals to shield themselves from uncertainty. For silver, booming industries like renewable energy and electronics mean higher demand, which can push prices even higher. The more technology advances, the more silver is needed. These four forces, interest rates, the US dollar, fear, and industrial demand, explain most of the wild swings you see in gold and silver prices. They're like the hidden levers behind every market move. So, it's not random at all. It's a reaction to what's happening in the world, from economic headlines to political decisions and technological breakthroughs. Understanding these drivers helps you see through the noise and make sense of the chaos. You'll be able to spot the patterns and anticipate what might come next. The market moves fast, and prices can change in the blink of an eye, but the reasons behind those moves are clear if you know where to look. Let's dive deeper and see what's making these price swings even faster in today's world. The sudden jumps, the fast drops, the sharp candles. This is not random. Reason 1. Markets are extremely sensitive to interest rate signals. Even one statement from a central bank official can change expectations instantly, and gold reacts immediately. Reason 2. Heavy short-term trading in ETFs and futures. Large institutions and professional traders do not trade physical metal. They trade through futures and derivatives on large commodity exchanges, such as the Chicago Mercantile Exchange. When prices move fast, many traders enter together and many traders exit together. This creates very sharp short-term moves. Reason 3. Gold and silver had already moved up strongly earlier. After fast rallies, markets usually cool down. This cooling phase feels dramatic, but it is a normal part of financial markets. So what you are seeing now is fast money reacting to news, fast money booking profits, and expectations changing very quickly. That combination creates volatility. So why own gold or silver at all? Not for quick profits. These metals are about protection, not speculation. Gold is financial insurance. When stocks crash or inflation rises, gold often holds steady or goes up. A small allocation, maybe 5–10% of your portfolio, can smooth out the bumps. Don't obsess over daily price moves. Make gold and silver the stable anchor in your portfolio. That's the real secret: steady, strategic ownership, not market timing. Now you know how the gold and silver market really works. This video is for education purposes only. Always do your own research and talk to a qualified advisor before investing. Make informed, steady decisions for long-term wealth. Thanks for watching, and invest wisely. Like, share, and subscribe.